All right, let's get straight to it. The
Yeah.
whole trade situation, it feels like it's been thrown back into the blender again, hasn't it?
It really has.
We're seeing this um, real resurgence of trade tensions and
Yeah.
these new tariffs that landed this year.
hmm
They're definitely not just more of the same.
You're spot on. There's a different energy this time. The new U.S. administration, the rhetoric, it's translating directly into policy that actually bites.
Right.
You know, that blanket 10% levy on most imports, then the staggering 145% on a lot of Chinese goods, plus significant tariffs hitting cars and parts even from Canada and Mexico. These aren't just, talking points anymore.
No, they're actively reshaping how businesses have to operate.
Exactly.
And this is all happening even with those recent U.S.-China talks in Geneva, right? They set up that trade consultation mechanism.
Sounds nice and diplomatic.
Yeah, sounds good. But the reality is those really high tariffs, they're mostly still there.
Yeah.
So this isn't some theoretical exercise. It's hitting bottom lines. Companies are genuinely having to rethink their entire game plan.
Precisely. And that brings us to the core question, doesn't it? How are these tariffs actually shaking up the key industries? Because when you look at the Q1 earnings calls from this year, 2025, and the market analysis, well, semiconductors, automotive, and retail seem to be right in the eye of the storm.
Okay, let's dive into semiconductors first. The silicon heart of everything. It seems like a bit of a mixed bag there with tariffs, like sometimes the raw chips are exempt, but if they're in something.
That's the tricky part, yeah. It's a critical nuance.
Yeah.
The complexity comes from just how global that supply chain is. Basic materials might dodge some levies, but the finished products using those chips, often not.
Mm.
And the uncertainty itself is a massive challenge. Remember those analyst reports from late April talking about potential new levies specifically on semiconductor-related products?
Yeah, they were floating like, what, 25%?
Exactly, a potential 25%. That just throws a huge wrench into planning. We could be looking at pretty significant price hikes going through the whole tech sector. It's not just about the direct cost of the tariff. It really challenges the whole established global production model. Even the giants are having to look again at their basic operating economics.
Right. A potential 5% increase for imported semiconductor products, maybe 4.5% overall.
Right.
That adds up fast. And we're seeing real effects already, aren't we?
Yeah.
AMD, for instance.
Yeah, AMD's anticipating, a $700 million revenue hit just this quarter?
Yeah.
And projecting $1.5 billion for the whole year, mostly because of those export license requirements for certain chips going to China.
Which isn't technically a tariff, but...
But the impact on the bottom line. Pretty much the same effect. It's just another way these tensions are disrupting things.
Right.
And then you've got TSMC, a real industry bellwether. They're openly acknowledging that shifting manufacturing to be more geographically diverse, which makes strategic sense. It just costs more. So they're having these, let's say, tough conversations with major customers about pricing, basically saying, look, if you want geographic flexibility, it costs more. That initial 2-3% dip they expect in gross margin, that really highlights the financial pressure.
So semiconductors definitely navigating some serious headwinds.
Yeah.
Okay, let's switch gears, pun intended, to automotive. A 25% tariff on imported passenger vehicles, light trucks, even auto parts. That sounds pretty substantial.
Oh, it is. It's a huge hurdle. S&P Global Mobility, they revised their forecast downwards, projecting maybe 700,000 fewer vehicle sales in the U.S. this year, purely because of these tariffs. That gives you a sense of the scale.
Wow, 700,000.
Yeah. It's not just the sticker price, it affects the whole supply network behind the cars.
And the big automakers are definitely taking notice. Tesla was pretty explicit, right? Saying these Section 232 auto tariffs will hurt profitability. Especially hitting their energy business because of those Chinese LFP battery cells.
Right, and their CapEx guidance. Over $10 billion now, partly factoring in these tariff costs.
Then you have Ford. They announced they expect a $1.5 billion hit to their 2025 earnings before interest and taxes, just from tariffs.
Yeah.
And then they suspended their full-year guidance altogether.
That suspension tells you everything, doesn't it? It's a very clear signal of just how much uncertainty they're dealing with.
Yeah.
And don't forget GM, over half the vehicles they sell in the U.S. could face these tariffs. So naturally, they lowered their earnings forecast too. Significant exposure there.
Okay, so the auto sector is definitely feeling the pinch. Now, what about, the stuff we buy all the time? Retail apparel. That jumped to 145% duty on Chinese imports back in April, plus high tariffs on places like Vietnam, Indonesia. That's got to be showing up on the shelves, or soon will be.
Oh, it's a direct hit. And the numbers are stark. Think about it. Roughly 99% of footwear and apparel sold in the U.S. is imported, mostly from Asia.
99%, wow.
So it's really hard to see how consumers don't end up paying more. These are everyday items, that t-shirt, those shoes.
Yeah.
Yeah, they could get noticeably more expensive.
And we're seeing it in the earnings already. Amazon's Q1 North America operating margin took almost a full percentage point, hit 90 basis points, just from costs tied to pulling inventory forward before the tariffs hit harder.
That forward buying.
Exactly.
And even Walmart, the company synonymous with low prices, they've had to acknowledge that these steep tariffs could lead to increased costs for our customers. That's a pretty big admission from them.
So short term, it sounds like a scramble. Companies trying to cushion the immediate blow, Amazon stocking up, like you said.
Yep, that front loading is a classic first response. Others are freezing new purchases, trying to burn through existing stock, maybe hoping things calm down eventually.
Right.
And some, like Micron we heard, are just planning to pass the costs on where they can.
But those are just temporary fixes, aren't they? What about the bigger picture, the longer-term, more fundamental strategic shifts?
Well, the number one long-term strategy we're seeing is supplier diversification. It's becoming essential. Companies are actively looking beyond their traditional bases.
Like Apple.
Apple's a prime example, planning to shift most U.S.-bound iPhone production to India, other products to Vietnam. They're trying to reduce that reliance on any single region that's subject to high tariffs. Now, they still expect a hefty tariff bill, maybe $900 million just for the June quarter, but it's a strategic move to lessen the overall blow.
And it's not just moving factories. Texas Instruments, you mentioned them leveraging their existing global footprint, creating dual flow capabilities. Sounds like building in redundancy.
Exactly, built-in flexibility. And the retail giants, Walmart, Target, they're actively hunting for and building relationships with suppliers in other countries. We're also seeing a definite uptick in interest for nearshoring and regionalization.
So Mexico.
Mexico's becoming a much more attractive hub for serving North America, yeah, despite its own trade complexities with the U.S.
Even Tesla, which already builds a lot domestically, they're pushing further on localizing supply chains, right? That 85% USMCA compliance is pretty high. And planning to make their own LFP battery cells in the U.S. eventually.
Right. That refers to the U.S.-Mexico-Canada agreement rules on where parts come from for tariff-free trade. And then you have strategies like NXP Semiconductors with their China for China approach.
Meaning?
Basically, produce locally in China for the Chinese market, insulate that part of the business from cross-border tariffs as much as possible. And, there are other tactics too. Things like tariff engineering, trying to classify products smartly under codes with lower duties.
Clever.
Requires deep knowledge of customs rules. Using free trade zones is another one, delaying or maybe reducing duties by storing or processing goods there before they officially enter the U.S. market. And of course, good old-fashioned lobbying for specific product exclusions is always happening.
It really does sound like this massive, complex game of global supply chain chess. But you mentioned Intel saying it's going to take time and cost more to really optimize their network for all these new rules, suggests it's not easy for anyone.
No, absolutely not. These are deeply woven global systems. Making big changes takes time, serious investment, and it often adds new layers of complexity, maybe even new costs initially.
It's also fascinating watching the difference between sort of the official company line from executives versus what analysts are saying. The tone can be quite different.
That's a really sharp observation. Yeah, management usually wants to project calm and control. You hear phrases like monitoring the situation, actively managing, confident in our ability to adapt.
Like the Walmart CEO, Doug McMillon, saying, tariffs are something we've managed for many years. We'll just continue to manage that. Very reassuring.
Exactly. Or NXP calling the direct financial hit immaterial, though they admit unknown indirect effects. Qualcomm saying no material direct impact, but they're watching closely. It's all about cautious optimism, maintaining stability.
But then you turn to the analysts, and they seem much more focused on the bigger picture. The broader uncertainties, like what about demand, supply chain stability, global growth?
Precisely. Analysts often take that wider macro view. They focus on the systemic risks. S&P Global Mobility slashing that auto sales forecast, that's a perfect example of the broader concern.
Right.
And while companies might hope to pass costs to consumers, analysts are looking hard at price sensitivity, especially now with inflation. Can consumers actually absorb these hikes, or will demand just drop? That's the big question mark.
And the market seems to reflect that uncertainty. Companies seen as heavily exposed without clear mitigation plans, their stocks have felt the pressure.
Definitely.
But then, like you mentioned, NXP, maybe being European with a strong China position gives them an edge. Investors like it shows proactive strategies might get rewarded.
Absolutely. Investors are trying to sort out who's navigating this well and who's most vulnerable. And things like the Yale Budget Lab projecting potentially, hundreds of thousands of U.S. job losses by year end because of tariffs, that really highlights the huge macroeconomic risks.
And the fact that major companies, Ford, Cummins, even Apple, have had to adjust or suspend their financial guidance for the year, specifically citing tariff uncertainty. That speaks volumes, doesn't it?
It really does. Shows just how unpredictable things feel right now.
So these tariffs, they're not just tweaks. They're really forcing a fundamental rethink of global supply chains. That China plus one idea we've heard about for a while, it feels less like an option and more like a necessity now.
I think that's right. Companies just can't afford to be overly reliant on one single source anymore, especially one facing these kinds of tariff pressures. It's driving a major restructuring of how things get made and moved around the world.
So in this big reshuffle, who looks set to come out ahead? Who are the potential winners?
Well, you look at contract manufacturers and export-focused economies in Southeast Asia, Asian countries like Vietnam, Malaysia, Thailand, they stand to benefit as companies look for alternative production sites. Mexico, as we said, likely gains from nearshoring, despite its own tariff issues. U.S.-based makers of specialty components and companies really focused on the domestic U.S. market, they could see a boost too. And don't forget the logistics and supply chain tech providers, the companies actually helping manage all this complexity. They're kind of the enablers here.
That makes sense. And on the flip side, who's most vulnerable?
Clearly, firms deeply stuck on China without flexible options are at high risk. Companies with maybe high-margin products but very limited sourcing alternatives, they might struggle to absorb costs or pass them on without losing sales. Industries that depend heavily on globally sourced critical parts, like semiconductors and electronics, they'll likely continue to face disruptions and cost pressures. Traditional retail and apparel, with those vast established global chains, and the auto industry, with its incredibly complex international parts networks, they look particularly vulnerable. This isn't just about moving a factory, it's about building whole new regional value chains, rethinking markets.
So when we try to assess who's best prepared versus who's most exposed right now, what are the key things to look for?
Well, the companies that started diversifying early, proactively, you mentioned Apple, Tesla, they seem to be in a stronger position, relatively speaking.
Right, they had a head start.
Exactly. Companies with inherently agile supply chains, strong supplier relationships across different regions, maybe like Texas Instruments, they have an advantage. Firms with real pricing power, strong brands, might have more room to pass on costs, although that's being tested everywhere. And those geographically hedged strategies like NXP's China for China seem more resilient. Retailers like Walmart and Target, who've been actively moving sourcing away from China for a while, also look better prepared.
And the least prepared, who's most exposed?
Companies still overwhelmingly reliant on single countries, especially China, without clear, actionable diversification plans. They're facing the biggest uphill battle. Automakers with significant production in Mexico and Canada for the U.S. market, like GM, face major exposure despite USMCA offering some protection. Firms in really price-sensitive sectors, thin margins already, they'll struggle to absorb or pass on costs. Holly Inc. was mentioned as potentially facing challenges just because the policy situation is so fluid, and even Intel, a giant, acknowledges it's going to be a challenging, costly transition.
So wrapping this up for investors trying to make sense of it all, what are the main takeaways?
Okay, first, you absolutely have to look sector by sector. Continued pressure likely on auto, semis, import-heavy retail, but potential opportunities in domestic-focused industries or those benefiting from onshoring or nearshoring. Utilities, healthcare, consumer staple sectors less directly hit by import tariffs might offer relative stability.
Got it. Sector focus.
Second, supply chain resilience is everything now. You need to dig deeper than the headline numbers. Really scrutinize the supply chains, the mitigation strategies. Sometimes those quiet pivots in sourcing can be hidden opportunities.
Look into the hood, basically.
Exactly. Third, geopolitical intelligence is becoming crucial for investing. Companies that can anticipate and adapt well to these trade policy shifts, they're likely to gain an edge long term.
Makes sense.
And remember, this isn't just about the next quarter's earnings. It's about long-term strategic positioning in a global trade environment that's fundamentally changing. Yes, there were those recent U.S.-China talks, maybe a slight thaw, but the underlying tensions and these tariff structures, they seem likely to stick around in some form for a while.
So maybe a final thought for you tuning in. How ready are the companies in your own portfolio for this? Are they showing that agility, that diversification, that strategic foresight they need to navigate these choppy waters?
It's really the critical question right now, isn't it? Because these tariffs, they're more than just costs on a spreadsheet. They're catalysts pushing a real reshaping of global trade, corporate strategy, and the effects will likely ripple out for years, well beyond just the immediate financial results.